Hi everyone, this is Michael Bengiat with Lifetime Investor, and this is the Market Trend Advisory Weekend Review video for February 4th, 2023. Okay, we got a lot to go over, so let's go ahead and get straight into it. We had a lot go on this week in terms of the Fed meeting, a lot of earnings, and the outcome of everything was the bulls took over and really went running this week. So our overall market trend, we are almost as strong as possibly can be. We're in a confirmed uptrend since our follow through day. I think it was on January 6th. So really, not in less than a month, we really come blasting off. Our market count is for the Nasdaq is 7 out of 7. Now we go up to 7 when we have a power trend on, and that's a certain alignment of the moving averages. The price has to remain above the 21-day for so many days, and the 50-day has to be an uptrend. There's various data that goes into that. But we turned on the power trend this week, and so now we can go up to 7 out of 7, which we are at right now. And what that does, it gives us a little more of a buffer. We can still go down to 5 and still be 100% exposed without having to start selling per the system. So it just gives that little buffer where you're able to, any kind of just small retracements in the indexes or pullbacks won't affect, and so you're not getting, pulled it out of the market and back in, so you're not getting whipsawed around. And then on the S&P, we're just actually one up day away from turning on its power trend, and that will turn the market count from 5 out of 5. It'll go to, it would be 5 out of 7. But we've been getting a lot of strength, and then finally, and there's almost no institutional selling days, and we're getting a lot of institutional buying, which is what we always want to look for. Because remember, the institutions are the ones that really drive the market with their basically trillions of dollars of buying power, and so you always want to be in the side of what they're doing. If they're exiting, and that's why you start seeing stocks going down, and sometimes extreme amounts, as we saw in 2022. But when they're actually buying, that's when you want to be in there. You just want to be riding their coattails, because that's the big money. A lot of people call it the smart money, as opposed to the retail money, which is sometimes called the dumb money. And traditionally, the retail investors come in at the end, and the institutions sell out to the retail investors, because they get in when they feel like they're missing out, and that's usually well past the time when you should be buying. Now you're actually selling, because you got in much earlier than that. The only sort of caution here is that for our individual stocks and non-indexed ETFs, we're kind of referring here to leading stocks. And there's a difference, and this is when our stock pick service, we're always looking to buy leading stocks, not beaten down stocks. The leading stocks are stocks that are at or near 52-week highs or all-time highs, and they're the leaders. They're the ones that are making, especially in a bear market, if they're making new highs in a bear market, there's something going on there, especially if they're a growth name. Sometimes you'll see the cyclicals and defensive stocks start making highs during big corrections, but occasionally you start seeing some tech stocks and other more growth names appearing, and those frequently will point you towards the next winners of the next cycle. So, but we've upped our exposure a little bit to 35%, but we're not getting that follow through on breakouts, and there's a lot of volatility around the breakouts, and we're still seeing a lot of failures. So that's a warning in this market. And as we know, as you can see from what's been going on with the indexes, they are rising because the money is pouring back into the beaten down old tech names, Apple and Tesla and Google, and there's just tons of names, but that's where the money's been flowing. And some of these stocks, not the bigger names, but a lot of them are up 100% just in the last month. It's crazy. I think we have Grow Generation and the Trade Desk. I don't think these are up 100%, but there's a lot of made just gigantic moves. It's a little bit of a warning, because those are not the leaders. They're the ones that people feel comfortable in, but a lot of those names will not be the leaders of the future. They're already down 40, 50, 60, 70%. And now they're just almost a lot of short covering going on, and people are buying them because they think, oh, they're so cheap now. They were 400 and now I'm getting it for, $60. That's a bargain. Well, this same attitude, unfortunately, is what caused people to lose tremendous amount of money last year because they were bottom fishing. Every bottom was the bottom. And this is now the biggest bounce we've seen. Now, whether this is the bottom or not, nobody knows. But bottom fishing like this is eventually gets almost everybody and wipes them out. So you have to be really careful about how you go about that. But we're always looking, especially in this individual stocks, non-indexed ETFs, we're looking at leading stocks. So we're not buying stocks that are down in downtrends and are down 90%. We're looking for the ones that are, up, making new highs. So that's the warning in the market. So we have to be careful because the money's just flowing back into the old leaders and is not really showing a lot of new leadership yet. Okay. In terms of our investing strategies, so far buy and hold has, our market count 2x is now beating the buy and hold, and also with less volatility. And our 1x, you can see we're a little lagging a little bit, but we've also avoided any kind of downtrend when the markets go into a correction or anything. So. And then in the SPY, we're trailing a little tiny bit, just because the SPY has not gone up as much, or the S&P as much as the Nasdaq. But it's looking pretty good. I know our XXX, which we're not using currently for this rally, is up. I think it's almost up 40% or something already. Just crazy because the index have just blasted off. Okay. Let's take a look now at each of the indexes. So you can see here if I just really quickly, if I show you this is the Dow, and let's look at the Nasdaq. You can see the Nasdaq is much stronger chart in terms of just recent action, where this is heading up, whereas the Dow is kind of flatlining here and forming a little base. So it just shows you the money is now kind of rotating out of the Dow and those industrial, more defensive names, and going back into growth names and tech names. So, but that's kind of a new change of pace because the Dow really led this market rebound for quite a while, and now you can see the money flowing back into that. And you can see here versus the S&P, look at the relative strength has really been dropping. So we're basically in a little trading range here. We'll see how it goes. It's kind of tightening up, which is a good sign. Usually when you see this less volatility, which would be nice to see in this market, which has been one of the trickier ones to navigate with so many big names and big economic reports coming out, and being sitting in front of those with any kind of size has been difficult. So we'll see what happens, but this could just blast out the top or it could go out the bottom. We don't really know. The S&P is a little bit stronger. Now, one thing I want to point out too is that all the indexes are above their 200 days. The Dow is just flattening out, and the S&P and the Nasdaq are still in downtrends technically. So we've got a little bit of what we call an angle warning. We're still downtrending, but we've come above that moving average. So as we're going to talk about a little bit later, we're still in that make or break area that makes the market very tricky at this point. So here we go, back to the S&P above the 200-day. And we're just about to have, we actually just had that golden cross where the 50 crosses the 200. That's usually considered a bullish sign. I don't really have much use for that. It's just, but some people use that and they think, okay, that's the delineator between a bear market and bull market. It's not that simple. So, but anyways, we're all getting that. It's a good sign for the bulls. What I wanted to do also is take a look at the longer term monthly chart here. And this still is a big concern for me. You can see here these gray areas. I've showed this chart a bunch of times in the past. The gray areas are just showing a sort of a channel, and we're more concerned with the upper part of the channel. You can see whenever and this is from 95 to 2000, whenever we get up above or even just touching this top of this channel, sellers would generally push it down. And we got above a few times. We had a bigger correction when we got more above it. Now here in the S&P, we just kind of rolled over into that big crash in 2000 to 2003. But here you can see every time we come up to it, we either hugged it or finally had a correction. And here we broke above it for, it wasn't quite a year. Well, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, almost a year. And then we've come down. It's a little concerning because when you go into these bubbles, you'll see this much more in the NASDAQ chart I'm going to show you in a second. But when you go into this, they don't usually just resolve themselves with a 20% decline, especially because this was driven by interest rates, coming down all the way even from back here. If I had a chart of interest rates, you just see this line descending, descending, and descending, and finally hitting zero. Actually, it hit zero right around here and stayed there with all the quantitative easing and all the Fed maneuvering they were doing. And anytime they would start to raise it, especially in 2019, market had a little conniption fit. They cut them again. And of course, we came straight back. COVID happened. Oh, sorry, that's COVID. We're back here in I think it was 2016 or 20, right here. You can see a little bit. It was 2018 and 2019. It was right around there. Then we had the COVID drop. Interest rates not only went to zero, but just flooded the system with trillions of dollars, had that final run. So, but for this to just come down a little bit and then head straight back up, very unusual, and it's not how markets usually work. In fact, if anything, they go down and they go farther to the downside than you ever expect. You can see that even over here on the financial crisis, 2007, 2009. Not only, we didn't break above a channel. I don't have that in this, but we really just waterfalled down until we finally broke down there. So that's a little bit of a warning of maybe this still isn't over. So here's the NASDAQ. Again, we have the declining 200. We're not yet at that golden cross. The 50 is still quite a bit below, but we're getting a lot of strength, a lot of accumulation days. You can see these higher volume up days. So it's all a good sign that institutions are coming back in, but is it overdone? So let's take a look at that monthly chart. So here you can see back in 95, this was actually connecting back farther down off the chart with the tops of some of the monthly bars. So, but eventually we came up and then we just broke above it decisively, went into a massive bubble top that stayed up there for a while. A lot of volatility. This was difficult. You always thought that this was just going to get blasting off. It looked like at the time, with everything changing, the internet changing the world, everything just looked like it was a new era. Of course, it didn't turn out to be true. And then we really took a plunge. A couple of really, strong up months. You can see right here, kind of faked people out. We came down, new low, and then we had, 1, 2, 3, 4, and then we sort of came back down and closed around there. But a really strong period with also thought, that's it, we're over. That's the end of the this decline, and up we go. And then we still had some more downside to go. But this is the typical fashion of what happens when you have a bubble. And sometimes you can almost look at it as that you get 3 waves. You have this first wave, back up, second wave, and then the third wave is usually the final wave. It doesn't always work, but it's a good sort of benchmark to look at. So here, going back to 2009, you can see we hugged it for a long time, and then we went above it for over 12 months. Starting after the COVID crash, which just look at the volume that was trading. This is also kind of a dangerous sign, this much money pouring into the market, and still is. But here you can see we've kind of come down, you can call this maybe 1. We came down 2, but it's fighting it right at the 10,000 level. The market didn't want to go any lower and then came back up. So it wouldn't be surprising to see a third leg down at some point, but it doesn't look like it's going to happen this week coming up, but you never know. We've also come right up to this resistance at the green. This is the green line here. That's the 41-month moving average. Now that's been sort of resistance. Couldn't even quite get that. So this is something we'll see if it can break above. It may not be able to get past that. So We'll watch that. If we go back to the S&P's one, that same 41-month proved to be support. And we had a bunch of months that just sort of got there. We did break it below it, came back up. 3 months really just come down to it. So you can see these are important support levels. And then we came up here, and then this pink line here, that's the 21-month moving average. We haven't really quite got there yet. So this is a big concern. I think this may not be that we've seen the end of it. It would be highly unlikely to have gone into this massive overvaluation, craziness bubble that we saw with meme stocks and all that crazy stuff that was going on, and just go down a little bit. Now, some people say, well, 33% roughly is what the Nasdaq went down. That's not a little bit, but in terms of bear markets, I wouldn't be surprised to see this down 50% eventually or so, but we'll see. This was a 89% drop or 80s. It was in the 80s. I mean, incredible. This really came down from 5,000 to 1,100. So not that this couldn't happen again. So anyways, I'm not saying that we're trying to be super bearish, but it's a warning that we may not have seen the bottom of all this. And then finally, the Russell index is really looking pretty strong. And that's actually a positive sign. We're actually just about to break above the August highs. And we're starting to see now more participation from small caps and mid caps, which is a good sign. They've really been not performing for a long, long time. And so that's, and the money has flowed into mega caps for a long time. So it's a positive sign. So let's take a look at the technicals now. A lot more green than we saw for a long time. The percentage of stocks above the 200-day, we're in the 60s now. That's just been rising up from the 20s at one point. You can just see the 52-week high-low ratio. We're getting very strong numbers now for a long, long time. If you go back to just a few weeks ago, this same chart in our videos, you'll see this was just pretty miserable. The lows were outpacing the highs just every day. We're getting a little extended here, up 10%, 11% almost in the Nasdaq above the 50-day, and little concerning there. Up volume has been really pretty strong. Not as strong. I mean, we have some really powerful days like on the 31st. Maybe not as much as we'd like to see, but there are positives, and we had a lot of negative for a long time. So that's all looking pretty good. Maybe it's a little over bullish, a little over optimistic. Well, sorry, I shouldn't say optimistic, because that's the sentiment's job. And this definitely is getting a little too optimistic too quickly. We have the VIX now is starting to go out of just solid red. We have the CNN fear greed is back to extreme greed, which is very unusual since we were down in just a month ago in panic and levels and very bearish levels. So add it all up, the put calls really dropped down, maybe too far too soon on the sentiment. So let's talk about now, when we put all this together, what's going on. So again, we had a big up week this week. It's definitely risk on. And Bitcoin is up 42% already this year. The ARK fund, which Kathy Wood's fund, which lost about 2/3 of its value last year, it's up 42% already. The Roundhill meme ETFs, this is one I've not really looked at closely. It's up almost 40% too. So that's a little bit of a warning. You see that money's just pouring back into the beaten down names, and that's not really showing us a lot of strength. It's just, a lot of that has also been driven by short covering. So on the plus side, the indexes are looking very strong technically. The Nasdaq's in a power trend. As I mentioned, the S&P is just one up day away from its own power trend. S&P put in a golden cross. And the Nasdaq is actually very close to being up 20% from its lows. A new bull market, if you can, just in a month. Very interesting there. Now that's not unprecedented. If I go back, let's go back to the Nasdaq. That's not this one. Some of these rallies that we had in 2000 during the horrendous bear market, these were very big moves. I think there was one that went up almost 50%. So you can have these, what they call cyclical bull markets within a secular bear. Now, we don't know if this is a secular bear market. Nobody's ever using that term yet. They're just looking at this. This is an ongoing bull market, and we just had a cyclical bear market within it. I still am on the camp of that's probably not true, and it'll end up being the opposite. But we're not there. And then finally, on the positive side, the S&P got above its resistance in the 200-day, and all the major indexes above their 200 days. We talked about that already. So on the other side is that the VIX is at levels that have reversed throughout 2022. Well, I've shown this chart last week. So you can see every time we got down to 18, 19, or even below that, the market reversed. That was the high. You can see this is the S&P, this black line here. So we had this in January, we had it in April, August, and then here we are in February, making we haven't got as low as the one in January, but that was really, the bull market was just ending and the bear market was just starting. So a little bit of a warning here. It's just showing that there's maybe complacency just coming into the market. So we have to be careful about that. Now, retail investors are pouring back in the market and back into the risky, beaten down names. That's something that we've talked about a little too. And there's a little chart here. Now, this is actually more concerning, is that I just read that the retail participation in the market has just surpassed the meme bubble days. So you can see here, it's just recently the percent of market value from retail orders got up to 23%. That's actually more when when GameStop and all these things were going on. We were hearing about Roaring Kitty and Wall Street bets. So that's a little bit of concern that this quickly the sort of the quote unquote dumb money is pouring back in, and especially they're pouring back into the more risky names, the ones that are in downtrends, and the ones that really are not showing any signs of leadership. They're just going up because they were so beaten down, and the perception is that, oh, well, if the stock's down 70%, how much lower can it go? Well, it can go down 70% more. You see, real careful. It's a dangerous mindset to be bottom fishing these stocks, but unfortunately that's happening more and more. And then, of course, this is from a short seller. Of course, he's betting that stocks are going to go down. But I think this is true. So every time these so-called meme stocks, the garbage, has taken off, it's been the end of the rally, not the beginning of the rally. So it's a little bit of a warning there. That usually, in the end of a bear market, the retail investor wants nothing to do with it. They got pounded. They are lying. They're hurt. They're in rehab. They're in the hospital mending, and their accounts are obliterated, and they're just like, I'm not going back in the stock market. And it's not the case going on right now. So another little warning there. We're still getting a lot of warnings from companies, a lot of layoffs. Sort of an interesting thing is that more companies come out and say they're laying off, 10% or so many thousands or tens of thousands of employees. The stocks are all going up. In other words, they're getting rewarded for cost cutting, but they're not being rewarded for actually increasing their earnings or sales. It's more just like we cut costs. So it's a little it doesn't quite sit well for a lot of investors. That's what's going on. But this market has just become super bullish. And then finally, we have economic data and reports. They're sort of often mixed at best at what we're getting, but the market's decided that it wants to go up. So why is this all happening? Because this week, the FOMC, the market's basically decided that the U.S. is going to, because of the FOMC decision, not to just raising 0.25, and the fact that Powell said the word disinflation, that's what really triggered this epic rally this week. And the market's basically decided that the U.S. is going to be able to avoid recession because the Fed's going to be able to successfully navigate a soft landing. And this soft landing is the holy grail for Powell and the Fed. And it's an economy which inflation comes back to the Fed's 2% target and doesn't tip into a recession filled with spikes in job cuts and pain. That's what the market's already pricing in, that he's going to be able to pull it off. We're already seeing inflation coming down. Companies are giving bad news, but it's over. That's where bad news is over. It's all going to be rosy in the future. So what this is a change in pace, because the market over the last 3 Fed meetings, every time the Fed would come out and give their policy announcement, the stocks would sell off, especially when as soon as Powell started talking. But that didn't happen this time. And so people are starting to take notice that there's a pretty big growing divergence between what the Fed's saying and economic reality. So pricing in the soft landing, which is what the market is absolutely doing right now, because markets always look ahead. They're discounting mechanisms, and they're always looking ahead 6 to 9 months. It seems like this market's looking ahead like 2 years, so which is very unusual. So but pricing in the soft landing doesn't mean it's going to actually happen. And this is why you sometimes get these very powerful rallies that just eventually peter out, because the market's looking out, and what they're looking at isn't really going to happen. So the result is that you have 2 big diverging views right now, and it's the stock bulls that are betting on the soft landing who are really pounding on the bulls, the bears. So, but this could end in 2 different ways. One, if the economic data comes in hotter than expected, and that means that Powell's going to have to start up his hawkish talk again, or if the economic data comes in really much more pushing towards recession, or in other words, the data is really weak, and that takes the soft landing off the table. Now, recently, the weaker the data, the market would go up. And then now, the stronger the data, the market goes up. So it's looking past almost everything, almost as if it's just got really blinders on. But it could be completely right. You never want to discount what the market's actually doing. We'll talk about that in the conclusion in just a minute. So it's going to take a lot of this Goldilocks data, not too hot, not too cold, until the Fed's next meeting in mid-March, for the bull's thesis to really be true, and we're going to actually avoid a recession. It doesn't look likely, but anything can happen. And just finally, showed this last week, the 10-year 3-month yield spread is definitely showing a recession's coming within the next year. It's only gone negative 8 times in the last 50 years, and all of them has been true. Some people use the 10-year, 2-month. There's various ones. This one's really got a good record. Doesn't mean it's going to happen, but calling this time is different is very dangerous. So just to wrap things up, expect just continued volatility, maybe more to the upside, and it's hard to tell. You definitely want to respect the trend and what the market's telling you. Right now, the market's telling us it is going up. It sees bullish future ahead. And so you have to respect that, and you want to ride the trend up for as long as it continues. We can argue, this is the thing. There's so many bearish prognosticators and market people. There's a few that are just like Robert Prechter of Elliott Wave. Elliott Wave is really interesting theory. I have 3 or 4 books on it, but it doesn't work in the real world. He's been bearish for the last 30 years. And occasionally he's right. When things do line up, market goes down, and his wave theory works. But for 90% of the time, 95% of the time, it doesn't work. So, but he's one of these people that is just bearish no matter what. So I don't think this market is going to last and keep going, and we're going to be in a fantastic market, new highs in the future. I don't see it happening, but I like to look at it and say, well, I want to be proven wrong. And right now, that's not being bearish is not the way to make any money. So you want to ride it up, and you want to respect the trend, but when the trend starts to change, you need to change with it. That's the best traders and investors are kind of like reeds in the wind. They just sway with it. You don't get locked into one mindset and stick to it, because you're not really dealing with what's actually happening. You're only dealing then with what you hope is going to happen, and that's a dangerous world in the world of the money and the markets. So a few things. Just the Fed has raised interest rates now 8 times since March 2022, bringing the federal rates to 4.50 from basically 0. And the Fed officials keep asserting that rates are going to go higher, likely above 5%. I think their terminal rate is 5.1. But the market, interesting, is acting like raising interest rates from 0 to 4.5 has no bearing on business or the economy. In other words, it doesn't make a difference. Companies are borrowed trillions of dollars at zero, and now they're going to have to continue to borrow at whatever rate they're going to borrow, and it doesn't make any difference. So that seems to me a real big disconnect between what's happening with monetary policy and what the market's interpretation of that. It has to have. You can't have, and a lot of these companies are not profitable, and when just the difference between borrowing money and really not have to pay for it, except for return the capital, the principal, versus you have to pay back a lot of interest on top of it. That doesn't seem to be a smart and accurate business phenomenon. A couple more things. Just the Fed's not the market's friend. We'll probably never see interest rates at zero again. Like it did keep it there for more than a decade. So we're a little bit of a different paradigm now in the markets. And even after the aftermath of the bubble, let's just say that the market did finally put in its bottom. Stocks are not really cheap, and in a rising interest rate environment, that doesn't. Historically expensive stocks don't really jive with higher interest rates. So a lot of cross currents. That's why I've kind of still put on this the dangerous make or break point in time. The cross currents are pretty extreme. The market's sort of bet one way, maybe against what is actually going to happen, but we'll see. But anyways, just to wrap it up, expect a lot of volatility. And again, you got to respect the trend. It's up. It could continue going up for a long time. We could make new highs, and you don't want to be going, oh, well, I thought it was this. I mean, I have my own opinions. Again, I've said I don't think this will probably last. I would not be surprised to see new lows, and that would be the final low. But it may not happen. Anything can happen. Could be that all the productivity from so many new tools and technology, and now we have AI. We have so many things that could just be rapid. As you know, the change is happening more and more rapidly in our world, and these could just be really changing the business world, where communications are instant. We're having more help with from AI and other technologies. It could just be that we're in a different environment. I mean, you never want to say this time's different, but it could be. So you have to have an open mind, but the market wants to go up, at least as of Thursday, because we had a down day on Friday. So we don't know. That could have been the peak of this thing. It could be just a short correction. Who knows? Nobody knows. Nobody has any idea what the market's going to be doing in March. So we'll just keep that in mind. So anyways, just be prepared. Stay with the trend, and we'll be back next week to see what this crazy market is going to do. Okay, thanks a lot.